we've been together long enough now. I probably don't need to go through my full history, but I've been doing this for about a half a decade now, and I've been doing all right about it. I've been consistently profitable for about 4 years now, and I am in fact a full-time day trader. I'm gonna go ahead and get this party started, and I'll kind of get my intro going while I'm letting people in. Good evening, everybody. Welcome to this third installment of hanging out with me in these boot camps. I hope everyone's been having a lot of fun and learning a lot, and adding some decent tool sets. This evening, I'm really going to focus on the cams, and just nice. Like, I'm just going to talk about the cam pivots and and how to use them, and then I got a little bit of book map I'm going to tie into the end as well. So I'm going to talk about cams, and then I'm going to talk about what to look for in book map and a couple examples of putting them together. So in this webinar, I'm going to kind of be bridging two of my major components that I like to talk a lot about, Camarilla pivots with the order book. Although each represents a different aspect of the total trading system, I thought it would be beneficial to show how the two elements pair together to help add context to the charts. So in regards, I'd like to continue thinking of this as a part of more of the where than the when. Right, the when is really what I'm talking about, tape reading, and the order book is it selling or is it not selling. Really, for here, I'm really going to be more focused on like the where as far as cams, and how to see like where those orders are that you're really going to be focused on as far as where to look for good price action. Right, so by combining the order book with the pivots, we can look for where we can expect to see transactional volume, and then we can watch the institutional players line up to highlight the critical pivot. To do this, we utilize a fairly new tool called book map, which is getting less and less new by the day, and I'll talk a lot about in the upcoming pages. If a market maker is motivated by transactions, then orders will steer the price along as we have volume. The order book allows us to read this process and more. So to start off, I want to talk a little bit about value. Now, value is a really interesting principle in the market, and it's a really key thing for understanding all the movement everywhere. Whenever we're playing the market, all we're really playing is the ping pong back and forth between value areas, right? What are value areas? They're areas of high transactional volume. Any place where the price sits for a very long time and gets transacted with for a very long period of time is an area of value. So when institutional players make plays, right, they're not reacting to price the way you're reacting to price, right? They react to value. They react to a portfolio concept, right? Institutional buyers can be willing to buy a range that spans multiple dollars, right? So they could say, hey, I'm willing to buy up to 1 million shares, and I'm willing to buy those shares anywhere from $150 to $160, right? And the price is at $155. Right, so the market maker, can go ahead and do some work, and they can actually accumulate and get those shares for those people. They really don't care if they get filled at 150, 155, 154, 153, right? So how do you know where the market makers are doing the majority of this business, where you have a large institutional buyer that's interacting with a large institutional seller? Right, and that is what the market maker's real job is. You will have large bids to the downside, large sellers to the top side, and it's the market maker's job to go to those buyers and then take shares from those buyers to those sellers, and back and forth and back and forth. And this is what creates value. Now, the problem with value, right, is value often is choppy. It gets a lot of price action in there. So a part of what we need to do as we focus on value, and we're going to talk a lot about acceptance and rejecting it, right, is we need to pay attention, right, to where these value areas are, because we actually want to trade the transition between those areas. Where a lot of traders, especially momentum traders, are having a lot of struggle is because you're actually playing inside one of those value areas. Right, so it's let's say you're all the way in a selling range. You're all the way up at the top near previous day's high. You start going long. All of a sudden, the price goes against you and you get stopped out. Then all of a sudden, you go short and the price squeezes against you and you get stopped out. And you're like, what is going on here? Why am I not going anywhere? And it's because you're stuck in an area of high value. Right, and it's exactly what you should expect if you're paying attention to it. It will be a short. It'll become a short later when it goes to that bid. but you need to catch it on the backside of that when it removes itself from the current value and transitions to the next value area. A lot of people say, how do you hold all the way for the long move? Well, you hold for the long move because it's left one value area. And if it goes from one to the, it's going to go to the other. We're going to talk a little bit about that. The market is just limit orders that create books in both directions, right? And we're just moving from large order to large order to larger order to larger order to largest order to largest order, back and forth over and over and over again, really, until we don't, right? So, did I just skip one? So that leads us back to the principal theory that drives the Camarilla pivot system. That theory is that because the market is made up of participants and that the participants are people or systems programmed by people, that the market will inherently overreact to value. You see, people by design overreact to almost everything. It's just a psychological reality, right? Every time you place certain stocks, they always seem to move the same way. You can trade them over and over again. That's because the people involved in the algorithms are participating in a very similar way, right? One of the reasons I like playing futures, I like trading the ES versus trading the SPY, because when I trade ES, I'm playing with institutional players and other players that, let's just call them, are a little bit more of a sophisticated trader. Where if I'm playing SPY and Qs, I'm playing along with all the other retail traders that have Robinhood that are less likely to be paying attention to the rules, right? I like ES because ES follows the rules. Why does ES follow the rules so well? Because of the participant class that interacts with it, right? So that's why I'm specifically focused on, if I'm trading the market, I want to trade in a future, right? Because those particular assets are the best to interact with, at least for my system. Right. So we have no real way of knowing which way things are going to go. This is why we need to watch what the overall bigger players do. Right. So since value is based on perception, it can be very difficult to find. So we do have some technical ways to find it. Right. VPOC is one of the easiest ways, which is the volume point of control. Right. This is where the price is going to get ticked the most times. And because of that, it'll highlight and show you where a lot of transactions are occurring. Right? You can also see large orders on the order book or on the level 2. That'll also give you an idea of value, right? So once we find value, right, value often consolidates and then the trend will either continue or reverse on light volume, right? This is an attempt to reject value. Rejecting value does not mean up or down. It just means to move away from it, right? Once we have value accepted, we then see the price attempt to reject in both directions, under, over the price. It'll continue to do that over and over again until it doesn't. That is exactly what our system is based on, taking advantage of that over and over again until it doesn't, and then taking advantage of the until it doesn't. Eventually, excess builds in a particular direction in the book, depending on supply and demand, and as imbalance starts to set in, the perception of value by its participants will start to change. Eventually, the price rejects an attempt to either return to prior value or go find new value. And this rejection is where your trade actually begins, right? It's very important to wait for the large participants to make decisions, right? So let's take an example of what I mean by that. And then I'm going to talk about what I like to call the gray area. This is an older order here on NCLH or a chart. You can see here that around noon, it rallied up and it hit a large order right up here, around $30.10. And you can see here, every time it interacted with this order up here, it got pushed away, pushed up, pushed away. So we obviously have a large seller sitting at this order. And no matter what we try and do to get away, we're not getting enough buyers to fulfill that seller and then continue on. Right. So some people would be looking to potentially buy in here for a breakout, but I assure you in a little while, this thing's going to turn around and run the other direction. Right. So you can see that we have a high value area up here, which is an area we're going to either trade towards, or if it gets above it, we'll trade back towards it from the other side and through. And if it ever breaks, we'll keep holding, and we'll hold and keep our position on until we find another large transaction to the downside to bounce the price. So let's talk a little bit about those cams. First, a little bit of maybe not accurate history and then accurate history, but I like the story, so I leave it in here. So Camarilla, which is a group of confidential, often scheming advisors, a cabal. It's a Spanish diminutive of Camara, room, Latin, sea chamber, blah. That came out of the book, right? So basically, a quote from the inventor, and I'm using quotes, right, on the Camarilla equation. This was from an interview with Nick Scott. Everyone asks me that. When I first started trading, I thought, as a lot of people do, that the markets were controlled by a secret insider club of powerful organizations who manipulated prices for their own benefit. I remember that at the time, I was smugly sure that this was so and was excited to be joining, as I then thought, this secret cabal, of course. As I learned more about the markets, I realized this was nonsense and that the markets were far too big to be effectively controlled, even by gigantic financial corporations. However, it still looked to me as though there was a pattern in what was supposed to be the random walk. The word Camarilla is based on this, and it's basically a small clique of advisors, and it was meant to be a joke. Now, this is really, really funny and a really interesting quote to run through by Mr. Nicholas Scott. What's the funniest part about it? Well, Nick Scott, for instance, did not actually invent Camarilla pivots. So that would be one of the most interesting things. Camarilla pivots were actually invented in the late 80s, or not by Nick Scott, by someone named M.B. Kurtzentwig, who is a Canadian economics student who actually did an intensive study of the markets and then created this equation based on what that participation was. Now, what's oddly hilarious is big, large market making firms like Citadel now, who do approximately 30 to 40% of the market's traffic at any given time, use the Camarilla equation to control their algorithms. Part of the reason why it works so well, because it's what they're using. Why not use what they're using? But it is kind of funny because, not so long ago, we were laughingly saying it's nonsense that the markets are too big to be effectively controlled, even by the gigantic freedom financial corporations. Let me tell you something. I could show you chart after chart after chart of the ES, the NQ, the SPY, the Qs, Apple, Microsoft, anyone you want hitting a pivot level and hitting it to the penny within the margin of error. I could show you hundreds of screenshots of this being true. It's definitely a large market being controlled by massive financial institutions, right? There's no way that kind of precision is capable in a completely participation-based environment, right? So understand, when we say it's manipulated and they use that M word, it is, right? Don't be fooled with yourself, right? There is a house. The house is playing with a stacked deck, and they're stacking the deck against you. This is why you have to let the house make a decision, right? The analogy I like to use is the blue whale versus the pariah, right? If you're a chum, right, and you're the uneducated trader, then you're going to be chum. Your stops are going to be where everyone else puts their stops. They know where your stops are because they have sophisticated algorithm programs and now things like order book depth that actually shows stop data, right? And they can see where all of the retail traders are all sitting on the chart at the same time. They can see all their stops just sitting down there, big old heat bubble, right? And then market maker, like a big whale, goes and scoops up all those shares and goes the other direction. Why not? It's just a whole bunch of transactions that are all available. All the retailers are going to stop out, lose money, and then get right back in. So why not just go ahead and do that, right? That's why you need to wait for them to scoot down. And when they come out the other side, that's when you hop on, right? You have to ride. If you're going to go long, you have to long or short the back side of the play, right? If it starts trending at the open and you want to reverse it, you need to wait for it to actually go through its entire, has to find value. And if you guys refer to my, I did the market phases 2 sessions ago, right? Refer to that. It needs to, it needs to climax. The volume needs to its struggle. It needs to do all of those different things and then roll over and become a reversal, right? So, but the cam points are where we're going to be looking for those things, right? So here you can see how the pivots are calculated. I won't spend too much time on there. If you have DOS, this is how I have them set up in DOS. I will have a PDF of this too, so you guys can have that. Color coding. I like coding the way that I do because basically, more or less, I color code places where I'm looking to go long green. This is where I'm looking to go short red. But remember, above S4 is all along. Below is short is a 4. So you got those. Okay. So one of the many things I'm going to talk about is the gray area. In the Camarilla strategies, we like to wait for tickers to establish value and then reject it. As the rejection happens, the goal is to play these extremes of the price action, right? So we have to wait for it to rally, and then we short for a long trip back down, or let sell off, accumulate, and then we buy it for a long ride back up. This gives us really, really good RVR, right? Because and good stops, right? In order to get stopped out, it basically has to make a new low of day. So it has to do something it's never done before for you to get stopped out, right? And if it does go long, the distance between you and getting the profit is very much within the stock's ATR. So it's really likely for you to get the profit before the stock turns around and comes and stops you out. So this is one of those really nice ways to kind of increase your overall hit is by picking good areas in which to actually buy or sell from, ideally in the bottom third of the previous day, in the top third of the previous day for selling. So we use these Camarilla pivot points basically to help us dial in what we like to call the gray area. The gray area are places you should not trade, right? This is a real big thing. One of the main issues most traders are going to make is simply just not being aware of where they are in the day, right? So think about it this way. I have some ad-libbing here, but I don't have this in the thing, but it's important. Think about it whenever you're looking at a candle. Right? The top of that candle is created because you didn't have enough buyers. The bottom of that candle is created because you didn't have enough sellers, right? There was someone lower who was willing to buy. There was someone higher that was willing to sell. You just didn't keep going up because no one was willing to buy anymore. You didn't go down because no one was willing to sell anymore. So if you start buying and you're buying an opening range break, right? And that opening range break is within the top third of the previous candle, you're really stacking the deck against yourself just by pulling the trigger, right? Because basically you're looking at it and saying, hey, it sold here last time. I think it's not going to sell this time. Like, what information would you possibly have for making that assumption, right? The only thing you can do is assume it's going to do what it did last time. Trying to predict when it's not going to do what it did last time, that's very complicated. And it requires a significant amount of risk tolerance. Right, it is virtually impossible. Right, you really need to. If every time it hits a level and it sells when it hits that level, I would assume it's going to sell off that level until it doesn't. Trust me, your hit rate will be more accurate with that assumption than it won't be. Right, because it's only going to break out one time. Every other time, it's not going to. Right, so if 8 out of 10 tries, you're going to get something in there. So the main thing we want to do is we want to make sure we are buying and selling in the right areas. So as we're looking at this, right, the main Camarilla pivots that I use are the 3s and the 4s, right? I'll talk to you about the central pivot range and how all that works in a second. But the main thing we're using are the 3s and the 4s, right? If we're above a 4, we want to go long, right? If we're below a 4, we want to go short. So if the price action opens and stays somewhere in here, I want to go long. If the price action opens up here above R4, I want to go long. If the price action opens under R4, I want to play that and go short. If it opens under R3, I want to play that and go short, right? Pretty simple. And if it opens under S4, short, right? 3, long, right? So now the gray area is something that really has to be considered at all times, right? This is the reason why I play this. When you're playing this range, this is basically in here is the over and over and over and over again until it doesn't, right? So and that's our principal concept, right? Is that the Camarilla pivots do the same. We're playing this action of the stock price doing the same thing over and over and over again until it doesn't, right? So anytime you start going long, right, and you start going long into this area, right, you're going long into the area where it is most likely sold. Right? If you're trying to go short and you're trying to go short into this area, you're going into the area where it in past has most likely and more often bought. And that's why we call these kill zones, right? If you're going to buy, you want to buy all the way down here so you can get a move through the buying range, because everything in here is a buying range, through the buying range into the selling range, which you'll get to the top. And then you're more or less on an S4, your S4 expectation is a move to R3 or R4. You're actually be all out here, right? Will you hold for a breakout on R4? Probably not, It's very unusual for something that opens and tests S4 to make it through R4. So if you get it to R4, you just cut. Why? No read, right? It'll probably chop here and then come back down and not get any higher than that anyway. Why hold it, right? So especially if you see a volume signal or the order book doesn't look good. So, but what this really does and the way it helps you the most is it's really going to keep you out of a lot of trades if you pay attention to this. One of the big ways we significantly lower our profit factor, right, which our profit factor is, it takes in more than account than just our hit rate, right? Because your hit rate just tells you if you made money or not made money, right? Win or lose, that's all a hit rate says. But a hit rate doesn't tell you if you made 1R, 2R, 3R, or break even, right? Hit just means you had a hit, right? So your hit rate, you can have an 80% hit rate, right? But you can have what would be considered to be like a 0.8 or a 0.6 profit factor, which means you're 50-50 in your trades and you basically make no money, right? Even though you have a high hit rate, you actually make no money. You have an 80% hit rate, but with like a profit factor of like 0.8, you're actually losing a little bit of money. Even though you have a 80% hit rate, you're actually slightly losing money, right? And this is because what often happens is because you're actually trading in the wrong part of the stock's price range, right? You're going long, and when you're going long, you have an opening range break, and that opening range break sets up right here. You'll see this happen with my fearless mentor, Andrew. He's a momentum trader, so him and I just don't trade the same, haven't for a very long time. But you'll see this happens, a bit in the room where he'll say, man, I don't know how Thor shorted here or why he shorted here, but look how, how that thing looked. This was an example of that from, hold on, where was that at? I think it was this Tesla trade. Doggone it. Pop open, silly. Right here. It's a shorted R4, right? It exploded off of S3. Good long from S3 too. This one played by all the rules, right? It was a long off of S3, just where we wanted it. And then look here, it came up, it wicked R4, and then immediately started hard selling right off of a big order, and it had an order book stacked to the downside, right? So I shorted here, right, and got that drop. But the only reason I could possibly take a trade like that, right, would be to not be concerned with momentum, right? This is a completely range-based trade based on range, volume in the book, right? I'm not considering momentum like Andrew does, right? So this is why we have these moments where you'll see him say, man, I don't know how he, I think that was with, and I'll tell you, Blake, I'll explain that here in a moment. So we want to make sure when we're trading that no matter what strategy you employ, right, that you take range into consideration. If you're trying to bring in the opening range, a 1 minute ORB, for instance, here's another really good example of of an ORB that I did recently. It was on AMD. And this was a 1 minute ORB, but it was taken near a buying range on the daily and the intraday. So we came in with a lot of volume right at the open. When we made that 1 minute ORB, I went long, and look at that, straight to R4. By the way, this is what I mean by when I say there's no way this thing isn't controlled by a group of computers. That level of precision is impossible. You know what I'm saying? These lines are drawn ahead of time. You know what I mean? DOS does them for me every single day, right? So seeing interaction at that level, it's wild, right? So I actually firmly do believe, and that's the reason why I'm able to trade the way I trade. Not to go too weird on everybody by making a religious reference, but it's kind of one of those things where you'd say, how would you act if you actually knew? You know what I mean? Like if you saw the face, would you really do the things you do behind closed doors if you really knew there was really going to be judgment? You know what I mean? Well, guess what? I'm showing you the face right now, right? You can do the things the way you're supposed to do them, the way I'm telling you you can do them, and you can do them because there is in fact control out there, right? There is in fact things that are adhering to rules, and those rules are things that can be observed and then reacted upon. Right. So what are the things I want? I want strong adherence to the level. We had a large order there and we had very strong adherence. We moved over. Look, we crossed the 50 SMA, right? We went from buying. Look at all the green, all the buying, and then we went to all red, went to selling with the cross. This thing reversed, right? So after I got that whole beautiful move on it to the long side, the thing actually turned around and had a nice little sell off there for a little bit, right? All off of exactly where it should have, every step of the way, right? Playing by the rules, right? So if you start to learn to play the rules, but the problem is to, you got to play the same song, once you learn the rules, and that's the hard part. That's what we're trying to do here. All right. So this is basically why we use the gray area. For those of you who love yourself some Livermore and Wyckoff, a little cooling, right? You'll recognize this stuff. But so remember, buying, selling, buying or selling. This is one of my favorite charts, actually. You can see here when we buy, we're going to be accumulating somewhere in this range, right? So if you want to buy, ideally you want to buy here or buy here, right? You either want to buy really low as it climaxes, or you want to buy on the back test. And then if you buy in either of these, the targets are R3 and R4, right? If it goes through R4, right, you're going to watch it. If it comes underneath, you can sell the rejection. But ideally, if you're going to sell this for real, right, it'll be this in reverse, right? You'll actually have an accumulation. That accumulation will adhere to the underneath of R4, and you'll get a good sell-off off of it. But this is why we're doing what we're doing, right? We're buying here because this is where it will buy. This is where it bought yesterday. This is probably where it bought the day before, right? This is where we're going to be looking for buying. So we will buy here once we see buying. So the only thing we need to see is buying, right? So by doing this, we can now delineate. This is where I want to buy. This is where I want to sell. If it goes up here, I want to buy again. And this really helps you out. So now let's start off talking about the next concept, which is judging which kind of range you're going to be expecting. So we have what's called an inside day versus an outside day. And this talks about value. So on a inside day, or confusingly, it's called an outside value day. But on an inside day, we're going to have basically a wide cam range compared to the previous day. So we're going to be utilizing what's called the 2-day pivot relationship. So basically, I'm going to look at yesterday, and I'm going to compare yesterday's cam pivots with today's cam pivots. If the cam pivots yesterday were really, really narrow, and today they're really, really wide, that is what gives us an inside day. Now, why is it important to know if it's an inside day or an outside day? On an inside day, there is zero, count it, one, not two, not three, but zero expectation that the ticker is going to break out. That's good to know, right? If you have a breakout strategy in mind, right? Like let's say you like break of high of day, don't play it on an inside day, right? Unless you're buying very, very low off of an accumulation, very low on the inside range, because you're not really going to get a big breakout. If you open near R3 on a wide ranged day and you try and play break of high of day, you're very, very unlikely to make money that day, right? You're going to want to be on a wide day. You're going to be focused on plays that run across the range because you're expecting to find value more in the middle. So you're going to run from the edge back towards the middle, back to the edge, and then back to the middle, up to the edge, back to the middle, down to the edge, back to the middle. And you're just going to do that over and over again all day long. There will not be a breakout. Real big thing to understand the difference of. Sometimes tickers actually just don't go anywhere. Guess what? More often than not, they don't go anywhere, right? This is one of the reasons we like gappers, right? Because the gappers let us find tickers that are going somewhere. But you know what? Why go through all the effort of playing all those crazy tickers and the crazy catalysts that are going all over the place when you can just find a nice ticker on an inside day and just play the ebb and flow? Kind of depends on your style. So the inverse of that is what we call the outside day, right? Guess who had an outside day today? Tesla. Tesla had an outside day today. For those of you who want to review through your charts, Tesla opened up off of a narrow range or off of a wider range yesterday, had a really tight range today, opened above R4, back tested R4, and then went on a breakout. But it was a perfect setup for an outside day for what we call an outside or a breakout. It was just an R4 breakout on an outside day. So it's perfect. So again, we have a wide range in the previous day. Today, we're going to have a narrower range, and that's most often just because of being bound to value. Less movement, tighter range, right? So we have a tighter range. Now we're going outside of that range. In the instance of an outside value, right, or an outside day, we're expecting to find value outside of the range, right? So in one instance where it's a wide range, you're expecting to stay inside the range. On an outside day, you're expecting to stay outside a day. Do we have any options traders in the house? Anyone who's looking at trading options and likes to do spreads and stuff like that? If so, if any of you like to do that, this is very, very handy, right? If you're playing option spreads, right, on an outside day, right, you do not want to play certain like put call spreads, right, because you're not expecting it to stay close to the price. So if you're looking for a directional move in the market, you're going to want to do that on an outside day, because on an outside day, you're more likely to have directional movement, right? On it, if you're looking to do something like, I don't know if if you guys have heard of like the Batman spread that Jared does, that him and I put together, and a couple of others, right? There's other strategies that when it's a wide range, you actually can play for it to close in the range, and you just capture premium, right? So there's a lot of different ways you could take advantage of these, and take advantage of cams for different strategies. All right, so I have this little cheat sheet available. So it basically just says all of those different things. One thing I'm going to add in here is what we call the neutral day, right? There are certain days when you look at them and you look at the cams yesterday and you look at the cams today and they look exactly the same, right? What we call that is a neutral day, right? When you're having a neutral day, you just play the cams as they are. You always, the good thing about my system is you always buy and sell in the same places no matter what, right? So it's just when you have tight versus wide, it gives you a little bit better of an idea of what kind of day you're playing. But if you don't have that, it doesn't change a whole lot. It just allows you to do that. Or one other little bonus you can try and do is actually go back like a day before, right? And look at like yesterday, like if you're like, let's say it's today's cams are narrow, and on Friday's cams, they were narrow, but Friday was a really low volume day. You can look at Thursday and say, hey, this is where stuff happened on Thursday, and maybe react off of that. But why not just go ahead and get away from that ticker and go and look and see if you can find a ticker before you do all of that has a slightly better relationship. So here's kind of an example of how that works. So you can see here on SPY, right? Look how narrow the pivot ranges are here. This is an outside day, and look how SPY on this day found value outside the range. But notice on this next day, right, it was a significantly wider ranged day, right? And we went from R3 down almost to S3 and then back. But see, we got stuck in the middle. It's all the same value area, right? It just takes a couple of days, but we get bound to it. We're stuck in range. The next day, again, tighter range. We open up near R4 and it goes into a breakout. Right. So the range is really give us a very big expectation of what we're thinking. If it opens high on a wide or a tight range and it opens high, we could be looking for doing a trending breakout, right? If it opens above R4, it could just be a breakout. But if it's a wider range and it opens inside the price, then we're just going to be looking to play that ebb and flow back and forth across the ranges. Right? Really handy to know, just based on just glimpsing at yesterday versus today's relationship. You can put an entire idea about how you want to play for the day. Super handy, right? So I just kind of talked about that a little bit now. So when we're forming our bias, right, this system actually gives us mini bias. Now, there's a lot of people out there who said you should trade without a bias. I would like to say trade without an emotional bias. Right? You shouldn't just like, oh, I feel like it's going to be a long, so I'm going to buy. Okay, don't do that, right? Obviously. But otherwise, maybe we don't call it bias. Maybe we just call it discriminatory, right? You should be actively disqualifying trades. Like if the trade doesn't have all the stuff that you want, it's not worthy of you, and you should not allow it to be. You should say, no, you don't got all the stuff I want. I'm not taking you. I need it all, right? I'm going to have to show this trade to John later, and he's going to make fun of me because of how silly this is, right? You got to, at least if you're going to be wrong, and then be able to show it and say, hey, I did this right and it didn't work. You tell me why it didn't work, right? So now the first thing before we really start to look at this, right, we're going to look, and so when our pivots are directly next to each other, or sorry, one slightly above, so like say yesterday we were here and today we're here, what we're seeing in that is that we closed higher yesterday. right? So our pivots are created by previous day's high, previous day's low, and then wherever the close is. And that's what creates our Camarilla pivots, right? Comes off of those calculations. So if our range is higher, what that means is wherever we closed was higher, right? Because, you know, if we must have opened here and we must have closed up here, and that's what shifted our range. So we immediately know, at least from yesterday, today, we're bullish. Now, does bullish mean we start longing? Unfortunately, no, right? Bullish just means we would prefer to be long, right? This is a bullish relationship, but it has to come back to S3 or come back to S4 after the open to give us a good area to buy on the intradaily chart, right? But this is what we would prefer to do. Now, just because we would prefer to go long doesn't mean we will, right? If this thing opens near R3 or R4 just underneath it, guess what? We're still shorting, right? And if it's a bullish bias and it's on a wide cam structure and it opens near R3, we're absolutely shorting, right? So just because it's a bullish bias, it doesn't mean we are long. It just means it's a bias. It's something telling you that yesterday the market was lower than this. Today we're a little bit higher. So the market's feeling a little good about this. It doesn't mean it's not going to stuff in 5 minutes. It's just, you know, we're just trying to dial in these things for our accuracy. Same thing for the bearish bias, right? It means we opened higher, we closed a little bit lower today. So now there are times, like I was saying before, once again, where we just have no bias, right? Either the cams are the same size or we basically have moved straight across. So our highs and lows are within the previous ones. On these days, there's two options. One, you trade without that bias, right? Which is just to say, hey, I'm just going to play the pivots purely how they are off the book, or say, you know what, I'm going to go find one with a bias. That's often my recommendation, by the way. The ones with a bias move significantly better. When you have ones that have no bias, what this means is they're in chop, right? These are tickers that are in value. When you see a ticker that has a neutral bias, you need to understand right off the gate that this ticker is in value, right? If it wasn't, it wouldn't have a neutral bias. Right. Yeah. Especially with low R vol. Yeah. Especially Nathan, that's a solid point. Right. So if you have this neutral and then low R vol, if you're looking for a ticker that's going to move and it's going to move well, you're not going to find it there. You know what I mean? You've got no volume and you've got a neutral relationship. So this thing has no attention given to it basically at all yesterday. Why would you think attention is going to be there today? I've done this a couple of times on certain tickers like Microsoft and stuff. Have no volume in the pre-market, but I like the range it's in. I look at the order book, it's flat like this. I look at the pivot relationship, it's flat. And I'm sitting here going, I get that it's in the range, but no one's doing anything with this. Why am I going to waste my time with it? And then sure enough, I look back at it, did nothing all day. I liked Meta today. I caught Meta towards midday, and I got like almost that whole sell off on that thing. That was really good, but it had a nice drop on its relationship. I wish I had a screenshot of that one. So, all right. So next, after we have our bias, bullish or bearish, we're going to confirm the bias. How do we confirm the bias? Open price. Where the price opens, right? If you're trading pre-market, the cams do work in pre-market, but you do not get the added bias confirmation and volume. Right. Once the market opens, once it's been open for a minute or two, price discovery will happen. Market makers put out all their orders, right? Then you can really start saying, okay, we opened in a selling range, right? We opened under R3. We bought up to R4 through a lot of volume there. I'm going to go short, right? So where you open is the next thing we're looking for. If we open above a 4, we're going to look for a back test to that 4, and then we're going to play it long. Either 4. If you open above R4, you look for a back test, right? And it breaks up. If you hold on a second. Hold on. Yes. It opens. If it opens above S4, you're going to look for a test to S4 and long, right? Both scenarios in that. Where that doesn't change is if it opens under R4. If it opens under R4, so you could be talking about literally a 5 to 10 cent difference, right? Can be the difference between opening above R4 and opening under R4, right? That opening confirmation is a massive signal to the algorithms on what that's going to be today, right? So if you see that open above R4, it comes back like Tesla today, opened above R4, came right back, hit R4 almost to the penny, bounced right off of it and went on a breakout today, right? If that opening position was everything, if it opened under R4, I would have looked to short it, right? Just because it was in that different spot, it completely changes it. And that's such a fun aspect. Imagine being in a stock and looking at the price, and just by where the price is at in relation to the daily chart, you know exactly what you want to do with it, right? You're no longer thinking about flipping positions, right? Not that you can't flip a position, but you would know exactly when to do that because the price would go into a different place, right? But because the price is no longer in there, you're not thinking about a long, you're thinking about the higher it goes, the better of an opportunity for your short you're getting right now, right? I'm in a selling range. I can only sell in this range, but it's buying. So I can't sell yet, right? I'm in a selling range, but I need to wait for it to start selling. And once I see it selling, I will start to sell, right? And that's where the book really comes in handy. That opening price and where it opens is a big, big confirmation, especially to our algorithms on what's going to happen, right? So, and then lastly, use that inside or outside day to judge what kind of range you're looking for, right? If it opens above R4 on a tight range, you're playing a breakout, right? If it opens above S4 on a wide range, you're going to be playing an entire traverse from S4 to R4, right? Same for the other direction, right? Just depending on the cam width versus the bullish relationship and where you open, you can dial in any play you want really, really quickly. Right. Oh man, this is an old one. Look, this is off of pre-meta. This is back when they called it Facebook. This just shows you it even worked back then. R4 breakout, tight cams versus wide cams, right? So here's a little cheat sheet for everyone. This will be available in the PDF just so you can look at this bullish, bearish, no bias, right? Opening positions to confirm, judge your range, and then let it open. And depending on what it does, right? If it opens here, you're going to buy at S3. Targeting R4 and all of these varied strategies. You can go ahead and, you can utilize those. You can also go to bearbulltraders.com if you would like, /pivot book. And you can actually download this screenshot off of there, which shows all of my plays based on those relationships and areas and how they line up. I have about 12 plays that I'm able to, employ basically or deploy more at basically any time and we go. So that's basically how the cams work and how we're looking to trade them, right? So next we really got to throw in the order book, and this is that last part I want to really tie in for a little bit before we call. But so when you're looking at the order book, we talked about this a little before. This is our depth of market, so this shows us our balance. So in DOS, right, we can use the highlight order feature to show these, right, or you can use something like Bookmap. Right. But what you can see by looking at the different book is what kind of phase your market's in. Right. So this for me is the last thing of deciding where I'm taking a trade at or not. Right. If I'm taking a trade and I'm looking to go short, if the order book looks like this in DOS, I don't even take the trade. Right. One more thing to disqualify all of these different things. Why don't I take the trade? Because this order book is balanced. Right. If transactional potential steers the market, this order book's going nowhere. Right. The order book on the right has so many transactions all over the place. It has nowhere to go. The order book on the left has all the transactions it needs really close to the price. Again, nowhere really to go. Right. So we want to look and find order books that actually have excess that is imbalanced in the direction we'd like to go. So for instance, you're going to look to play an opening range breakout. Right, you want to buy that opening range breakup at S4 or S3. You want to buy it with a lot of buying volume, and you want to buy it into a bullish order book, right? Because these are all the things that are going to let you know all of those small things. Toast, as Blake threw in there, right? All of those small things coming together at the exact same time is how you know it's time to take a trade, right? If it's just the bullish book, it's not time. If you're just at the pivot, it's not time. If you just see buying, it's not time. Right? If you just see a VPA, it's not time. It's only time when you have the pivot and then you see the VPA with the right book and buying all happening at the same stinking moment. We were actually talking about this a little bit before we started this session, right? Which is what is so difficult about stock trading is the easy part is that these setups happen all day, every day. The hard part is these setups are only viable for about 5 to 10 minutes at a time. Right. So I kind of like think of this as like, like the re-entry window for the old school space shuttle before you came back in you know, they basically, like, if they didn't hit that window, they had to wait, and then they'd have to land in like White Sands, New Mexico. I don't know. You had to have seen Space Camp. Am I the only 80s baby in here? Anyway, you had to miss the first window, so you couldn't land there. We couldn't land in Houston, so we have to fly, and now we're going to land in White Sands, New Mexico, because we missed our reentry window. Right. So, but those entry windows exist, right? They can just keep hitting new entry windows, but they have to wait for that right window. And that's what happens with our system, right? All of our systems, all of our, this is where you'll notice, like, I was right, but I didn't get the move. Like, I knew it was a long, I bought, but I got stopped out, and then it went into my position. That's because you're missing just one of those little aspects, right? Like, it wasn't buying yet, or you didn't quite buy it in the right range, or you didn't quite get those things. And because of that, you just missed that window, which itself, although it happens all the time, that window is really only viable for a very short period of time. So it's like, maybe 5 to 10 minutes where you can buy and have the right range with the right book and have the right RVR, because that's the last part, right? Is actually buying or selling when you go long or short, and actually being able to put yourself close enough to the edge so that you feel comfortable leaving your stop there, but still being able to get to profit before you run into contrary forces. So this is why that entry location is so precise on getting right there. So, but having the right book really helps with that a lot, right? So this is a bearish example of a book here. You can see to the downside, we have all large orders to the, pointing towards the downside. So this ticker, if volume hits the bid in market orders, is going to run straight down. Right. So one of the other things which I really like to isolate and look for is something called an iceberg. I'm sure many of you are familiar with that. Believe it or not, an iceberg is actually something you can do if you really want to, although most of us don't. DOS actually has a display field, which is right here. So like if I wanted to trade 40,000 shares in DOS, I could actually only display 1,000 of them on the order book at a time. At that limit, if I really wanted to. I don't know why I would do such a thing, but just to show you that even us lowly peons can do it. But this is the big way that the large players hide their initial volume, right? Imagine being going into a housing market and saying, I want to buy a house, right? And as you walk into the neighborhood, all of a sudden you look around and you notice 3 out of 4 houses in this neighborhood are for sale. That's going to freak you out as a buyer, is it not? If you're looking for a good return on investment here for the whole house, you walk in there, it's like, what is going on? Are there power lines? Like, is there a reclamation facility near here? That might just be Florida, but are there reclamation facilities around here that are stinking up the joint? Like, why does everyone want to leave here? Well, the same thing happens in the market, right? Exactly, like, this happens in the market. If they put too many shares on the book, we're all going to see them, right? And we're all going to say, there's no way there's enough volume here right now to go through that many shares. So we're going to just start selling now, right? And then that'll make the price move away from them, and they won't get their fill that they want, right? They want to sell at that level, right? So instead of putting all their shares out there, they just put out a little of them. And then every time the price interacts, it does what? It absorbs, right? Absorption is done off of icebergs. Right, you'll hear Paris talk a lot about an absorption, right? Which is basically if you're trying to buy, you don't have enough buyers to go through whatever limit ask is there, right? So anytime the market maker tries to average over and move up, they can't. For anyone who doesn't know what I mean by average over, when market makers want to move up, they have to average over. So what that means is when a market maker sits under a limit ask, let's say they want to go up. The market maker sits under the limit ask and then allows market orders to come in, and they fill those market orders above the limit ask, right? So let's say it's $100, arbitrary number. Let's say it's $100, right, is the limit you're at. The market maker will keep the price at $99.98, right? And then they will allow you to buy for $100.02, right? And they will continue to do that until their average is actually over the cost of that order, right? So they're actually averaged over the cost, right? So then when the market maker is ready to fill, all they got to do is move the price off, boom, and they've already got an entire accumulated warehouse ready to fill that sell order, drop down into it and start filling it. and they've already averaged over it, right? So, but if they're trying to average over and get over, and every time they do, the order book is getting blasted with sell orders hitting the bid, which are market orders that they are forced to transact, right? Because market orders say, fill me now, you know, so now they have to fill this. It's going to make it really difficult for them to get that average over, and that causes absorption, right? So if you're seeing that absorption and they're constantly, every time they try and push towards the order, they're not getting the volume they need. But not only that, they can't even push. They can't move the price up. They're being overwhelmed. Then as they pull back, selling comes in and they're forced away. Well, they're done, right? You can know just by reading that moment, they're not going to have the volume to go through that order. Every time they try, the buying dies, the selling increases. This isn't going to happen, and you fade it, right? It's not necessarily full-on reversal, but it'll certainly be a fade, right? So paying attention to icebergs is really, really handy. So here's an example of like one looks like. You can see here, the green dot, green dot, green dot. We're just going up real big here. This is Bookmap, by the way. Go up right here, and look, we hit this big sell here. What? Why are we selling? And we start buying and buying and buying and buying and buying, but we're not going anywhere. What's going on here? And sure enough, we start to, you know, all of a sudden there they are, right? They throw their hand out there. Oh, there's a bunch of shares here, and the market goes, oh, screw this, right? And we just start running away from them, right? Because the market starts just selling away from them, because, you know, what if you're like walking into a neighborhood where all the houses are for sale in the neighborhood, why on earth would you start buying if you've got this many orders right above you? Why not let it drop and buy somewhere down here for the move back up, right? Pretty handy. All right. So what is a heat map, right? So Bookmap's a heat map. Just wanted to kind of introduce you guys a little bit for those gals and gals who haven't done the whole Bookmap thing. So it's a kind of a heat map, or a DOM, right? So DOM just means depth of market. L2 is a DOM, right? L1 is not a DOM. L1 is just L1. L2 and L3 are DOMs. Heat map's a DOM. So it's just depth of market. So, basically, it just allows an easier visualization of both the order book and time and sales. One of the biggest advantages to using a heat map like this is the historical value, actually being able to see where the orders were before. I don't know how many of you have been trading around for a while, but if you talk to anybody who used to trade, who I used to trade around in the main chat room with back in a couple years ago before Bookmap, one thing they'll tell you about is how I used to scribble on the screen a lot. It's pretty hilarious. It's in some of my old videos, maybe on YouTube, but you'll actually see I was using DOS's level 2, and it's split on both sides, right? And as the order book's going up, I'd be watching it, and I use the order highlight feature. So I'd see like 150 lot, 200 lot, 150 lot, and I would actually use my Epic pen, just like I use while I'm talking to you guys. And I would actually go over, and on the order book, I'd actually write 120, 110, and like 115, because I would look back at it 5 minutes later, and I'd have to look at it, and I would see it and see if was this 120 still, or was this like 150 now, or was it 30? And I could actually see if they were increasing the order or decrementing the order. And it was really, really handy. And it was something so I would just have scribbles on my page while I was doing that, which was kind of hilarious. But now that you have order book, we can actually see, oh, well, there was an order here, they filled it. There's an order down here, they actually lifted the order and pulled it up here. We know they lifted it because it came off at this price and came up on this price right at the exact same time. Only a computer could move an order from there to there that precisely, right? Now, I mean, it might not have been a computer that initiated, but it was someone either dragging and dropping a stop or something like that, but you can see it a mile away, right? So the advantages: historical information, easily identify areas of high supply and low supply, right? Keep in mind order voids, right? So if you were going to long, would you long in here? And the answer is no. And the reason why is because of this. There's an order void up above the price, right? The price will not be able to go through that area without orders being built in. Look how we buy up later. Look how they fill it in, right? So they had to build up orders before they were able to go higher. So the long would be here after they started building the orders, but I wouldn't have longed that one either way. It's kind of gross. But all right, let's see here. I talk about the market. This kind of shows that jigging. The market likes to come down near orders and then pull away from them and trying to get large orders to move up. And if they do, they start squeezing. So we call that jigging. And the reason I do is because it looks just like jig fishing. I actually included this little thing. It's really how the market gets you. They move it down, and then they try and jigging the market isn't just about actually jigging the market, the big players. It's about getting us, right? They pull the price right down into the area where we are, flush out our stops, and then pull, right? So you can kind of see that happen, which is always a lot of fun. We talked about DOS, bullish and bearish, right? So here's what that looks like in a heat map, which is why that's such an advantage. This is what a bullish order book looks like in a heat map. It doesn't actually come with a little bull next to it. I put that there, but I really feel like this should be Bookmap's next feature. They should really just add in a giant bull that pops out when it's bullish. But anyway, you can see here to the downside, we had virtually no excess to the downside as far as heavy orders. To the top side, lots of orders and lots of green dots. So not only was this thing buying, it was buying into a very well-tiered and bullish order book, right? So basically on coin this day, it was going up, right? Just the question was, could you get in it? So that's always fun to know. So in the Bookmap, dots are market orders in Bookmap. Limit orders are the lines, market orders are the dots, right? So buying, when it's buying orders, they come in as green dots. Red dots come in as selling orders. Now, that doesn't mean they were on the bid or on the ask. That just means they were buying or selling. So they could have been buying on the bid. They could have bought on the ask, right? It just means where the market order. So where it gets filled is important to pay attention to. But notice you got to have the large red dots. See how we get the big dots, and that's what allows us to sell through. You have to have market orders to move, right? So you have to keep that in mind. All right, so let's see here. Cumulative volume delta. One little thing to add in for a lot of y'all who are having trouble differentiating. I don't think I put that in here. I didn't. Let's talk about cumulative volume delta, which is like volume. It's like the volume dots, but what it does is cumulative volume delta is actually the amount of buys plus the number of sales. So you end up like with a number that lets you basically say, is it buying or is it selling? So CVD, especially if you use Bookmap, is a really handy tool to just look at a ticker and say, hey, you know what, today it's buying. Today it seems like it's selling. So, and this is that pressure concept that I was talking about, where you have to have certain orders in order to be able to push up or push down. If you get market orders hitting the ask and there are orders to the top side, it's gonna move up. And this is very similar to how aerodynamics work on a plane's wing. A lot of you might not know this, but like a plane's wing basically moves up and down basically because it forces wind to move faster over one half of the wing than the other, the top versus the bottom. This is exactly how the algorithms know to react to price action. So if there's orders laddered to the top side and an order comes in and it's a big market order and that market order buys the ask, the price is going to go up, right? And so if there's enough volume there in order to liquidate all the limit levels to the top side, it's just gonna go up, right? So these are the kind of things to really get in tune with, because once you learn to recognize these things on a broader scale, you basically at any given time know if the price is going to go up or if the price is going to go down. Will that sustain over time? That you don't really know, but once you learn how to read it in the short term, you just keep reading it. You can say, okay, it's going up. It's still going up. It's still going up. Uh-oh, things don't look right in the order book. Looks like it's about to come down. Does it start selling? Okay, it's selling. I'm out, right? So you can really start focusing in and keeping attention to these. The order book is massively affected by news as well. So you need to really pay attention to this kind of stuff. You can actually see how the order book clears ahead of news events. Like this was at 8:30 in the morning before, I think it was CPI or something was coming out. Completely empties out the book before it goes. So, or maybe it was initial jobless claims. But you can see on these days, these moves get really, big moves as you're going through. Right. So again, why the cams? Why the books? We're going to get better entries here. We have better directions, and we're going to get better moves and positions because you can actually use a wider stop and go for bigger targets when you're using this. We call this not tripping over dollars to pick up dimes, an old school saying from my grandfather. Right. If what you find is quite often, right, you actually have this high hit rate, right, but you're not getting a lot of profit off of it. What is often happening is your stops are actually too tight and you're going for too small of a win, right? By getting too tight, you're getting caught up on all the chop in the action. If you actually get a little bit wider, go for a little bit bigger of a move, you'll be surprised your profit will actually go up. So This is a really nice example in the order book of what this is. So when we're reversing, this is really what we're looking for. This would be like where our cam pivot is here, and we look for book flips. You can see here how our orders are really strong to the top side, and we're trying to buy, but every time we try and buy up through these orders, we're getting shaken out. We buy up, we get shaken out, we force our way all up there, really big VPA signal, immediately start selling, and we come back up and we find an iceberg there, and that's enough to kick the market away. And look how hard this sells. How do you know this isn't gonna come back up? Look at the order void left behind as it sells, right? You knew this had the potential to reverse because you could actually see the structure in the order book to the downside. This one's not coming back, right? When this one's going to keep going down, and it's not going to bounce for a very long time because there are literally just no orders for it to bounce up if it wanted to, right? So there we go. Here's kind of a Tesla example, kind of very similar here, right? Incredibly bullish order book, right? As it opened up and ran to the top side, right? You can see ES moving down the book to a very specific level. That level happens to be right at S4. You can see another transactional S4 here at this level. S4, look how it bounced right off of that buyer. So we have here, and this is what I talk about correlation, right? I'm looking at S4. I want to play a buy on S4. I have a buyer sitting right at S4, right? So I'm going to trade towards S4 when it hits that buyer. If that buyer holds, absorbs, and then we buy off of them, I'm going to go long, right? So you'd actually see it test, go through, and you'd see me going long right here, probably as it broke up. So AMD trade that I took based on this kind of action, look how you can see it pushed up, and it started to push up, and it actually climaxed out big volume point as it went up into a large seller, and it caved with this book, and as it fell down, you can see I got short here, even did a little add. Why did I add? Because it pulled back to a big seller, right? As soon as we hit that large seller, I added into the position, right? Order book helpful. So, all right. Well, everybody, it's about 8:05, and that got me through it. So I hope that was, I mean, it's a lot of information. This will be recorded, and I'll get a PDF up for you. So please take a look at it. If you have any questions, let me know. But I hope you all enjoyed it. I hope even if you don't actually like implement the Camarilla pivot system, that at least you can utilize it along with the book to maybe augment your current system so that you can get like, you know, some better entries in better areas and get longer lasting moves so you can get that profit factor as high as possible. I hope everyone has a great evening, and I will look forward to seeing y'all on later. Also, way fun trading with everybody this morning. I'll talk to y'all later, and keep it green. Bye.